Now to make some money with Ryan Irvine, Keystone Financial. You can find him at www.keystocks.com. Ryan, thanks for taking the time on the weekend.
Hey, it's great to chat with you once again.
I got to talk to you about a big winner that you guys have had, and I'm proud to say it was done on Money Talks. And I'm talking about the Boyd Group Income Fund, Boyd Auto Body, but Boyd Group Income Fund. You know why? Because I was looking at it the other day, and the thing is trading at $85. And you recommended it on this show at $3.
Yeah, I mean, thank you for pointing out that company. It's been a tremendous long-term winner for us. The company, it's such a simple business, which is what we like. I mean, all they do is fix cars. Recession or not, you got to get from point A to point B. And this company has done a tremendous job building its business over time. It's gone from when we recommended it in 2008, $2.30, to today, it's trading at $85. And it's funny because I actually got a call yesterday from a client, and we talk about this company all the time, so we get a lot of questions and calls about this. But we had recommended this company at $3 on your show and at a conference that you did in 2009 called the Surviving and Thriving Conference, and she had paid $3 for the stock. Since then, she's been paid over $3 in dividends, and the stock, the 3,000 shares that she bought for around $9,000, are now worth $255,000. And she called just yesterday and said to me she wanted to thank you for putting on that conference. So I'll pass that along to you.
Well, that's very nice. No, seriously, I love to hear those kinds of stories. Obviously you do too when you've put the research into it. But I mean, that's what we're trying to do here.
Honestly,
sorry.
Yeah. It kind of moved me in her voice. You could tell that, and she said to me after that, she said it really impacted her life, and it changed her portfolio, and really that's. You cannot find a company like that every day, but, it has us examining when we find a winner like that, what are the common things that we see in a stock like that? And one of the things that this company has done so well is every year it's increasing its dividend, right? So it increases that. It has a discipline that's been put in that company to increase that every year. And we see that's a common theme in some of the greatest winners that we've had long term. Or if you look historically, the greatest winners over time are companies that are what we call dividend growth stocks. And this is something that we definitely look for in a stock. And if we can find that, we can find the next great dividend growth stock, which we think Boyd is one of them now. We still like the company despite the fact it's gone up. But if you can find those companies, and you put a couple of those into your portfolio over your lifetime, it can really change your portfolio.
Well, I mean, that's certainly a theme, and I'm again proud to say, I remember it was March of 2009. Keep in mind, we're coming into the depths of that credit crisis there, and I'm saying the kind of stocks that I was comfortable with were exactly what you've just described, real quality stocks. And if you're looking at the growth side of your portfolio, that have a profile that constantly increases their dividends. And why, by the way, for me, Ryan, was because I saw this low interest rate environment getting more extreme. I certainly didn't see 15 countries with negative interest rates, I might add, but I did see a low interest rate environment being the sort of norm going through, because we just wouldn't get a level of economic growth that really justified any kind of significant rise in rates. So, I like that kind of a stock to this moment. I still think that provides some protection for us. I mean, I can think of some other, or maybe ask you, maybe one other, can you think of something else off the top of your head just to illustrate that approach?
Yeah, I mean, well, for dividends unto themselves, like you always talk about companies that or just the reckless and irresponsible spending that we see of taxpayer dollars. You were talking about that today by politicians and bureaucrats. Well, we see the same thing in management teams of public companies that we invest in. They treat shareholder money like it is their own personal stash. Well, it's not. It belongs to shareholders, and a great way to remind them of that is to have a dividend that they pay out every quarter to their bosses or to their shareholders. And if the goal is to keep raising that every year, management becomes far more accountable, and we see a dividend putting that accountability in there for management to shareholders. And such a powerful effect on returns over time. You look at some of the greatest companies long term. We're always looking for the next, say Johnson and Johnson, right? Over the past 54 years, every year this company has increased its dividend. Over that time, its share price has been up 4,800%. If you look at Coca-Cola, a track record of 54 years of consecutive dividend hikes, tremendous returns over that time as well. Lowe's, this company started very small, but it's become the classic big box home improvement chain. Now 53 consecutive years of increasing its dividend. And P&G or Procter & Gamble is probably the longest streak in North American history. It's 60 years of consecutive dividend increases. But all these companies have tremendous returns over the past 50 years. Now, to be honest, it's very hard to find that company, but like I said, if you can find one or two in your entire portfolio lifetime, it can have a massive impact on your portfolio. And this is what we're looking to find every day, is good quality dividend growth stocks, or the next Procter and Gamble. And I think a company like Boyd has that potential to continue to grow its dividend over time and continue to increase shareholder value. And those are the companies that we look for.
One of the things that you're doing, by the way, I just let people know on Key Stocks, it's Keystone Financial, but the symbol or the URL is keystocks.com. But I've been interested to see you've started up your own podcast that explains a lot of this stuff.
Yes, well, I think my wife finally got tired of me talking stock to her, so she told me to go in the padded room and talk stock to myself.
Do I ever know what that's like, by the way?
That's probably how your show started, right? No, but
yeah.
I think Aaron had the same problem with his wife, so we decided to just record it. Yeah, I mean, we talk stocks, we review companies, do a star and dog of the week, and I rant about some issues. But I encourage your listeners to go to our website and go to the podcast section, take a look at that. We have a Your Stock, Our Take. They can submit their stock, and we give our take on individual companies, questions from listeners every week. So I'm glad you pointed that out, and we'd be happy to take questions that way too.
Well, one of the things that, as you say, you've talked about Boyd on that, but here's the thing that's I find a real challenge. You get, like the woman that you described who gave you a call. I congratulate her for being able to hold a quality stock through upticks and downticks, and that's that whole problem then of when you've got some winners, and Keystone has picked a ton of winners, but when do you sell? When do you guys issue I get the buy side, but what about the hold side and then into the sell side?
Yeah, it's such a great question. With Boyd, it is a company that we try to hold the hand of our clients over time. It is a company that the lowest rating we've ever went to. We have a near-term rating, so a rating that we look over the next year, and then a long-term rating, 1 to 5 years out. The lowest rating we've ever had is a hold in the near term on it, and we always had a long-term buy on it in that period. So we just look at the fundamentals. This company has always traded at a discount. Still now trades at a discount to what the market multiple is. If you look at its EBITDA or adjusted cash flow, it's about 16 or 17 times next year, and the market's trading at 18. If this company was to go to a premium 25 times, then it's not cheap. It's a great company, but it's not cheap, and we take our money out of the company. Mm-hmm. The other factors that go in with a company like this too is we look at this as a very recession-resistant business. So there are cyclical companies, like if we're looking at an oil and gas or an energy-related stock, we're always looking. If it crosses that line where it's grow or its multiple is higher than its growth rate, we're selling that right away because we know that sector is inevitably going to go into a downturn. So there's a higher level of risk associated. It depends on the business. It depends on the individual company we're looking at, but. And there are also times where, we recommended a company just this last fall. The stock went up 115% in about 4 months. Well, we took half our position off the table. So you take your capital, your initial capital investment off, and you can let it ride long term. So there's strategies like that we'll use over time. And then there's some times where a company you pick, it goes wrong. The market turns against it. So the product doesn't work the way we would think it would continue to work, and then you've just got to take your lump and move on to the next company. So it's very company specific in terms of what we do. on a sell discipline. But like you said, it's very important to have that discipline to know when to sell.
Speaking of individual stocks, I'll come back with Ryan, talk specifically about that. And as I just mentioned, go to www.keystocks.com for Keystone Financial. More with Ryan Irvine right across the Money Talks Network. Keystocks.com. If you go there, there's a special offer on their site with the release of their Breakthrough Small Cap Report on video. Breakthrough Small Cap Report. www.keystocks.com. Ryan, speaking of that, I mean, one of the things that you've extended in your service, you've done very well in Canada. You started to grow and you started to look at hundreds of different potential opportunities in the States. And, obviously with the change in the Canadian dollar, the drop, over the last 3 years, that alone made a big difference to you. But do you have give us an example, the kind of stock you like down there?
Excellent. Yeah, we expanded into that market, and I'm going to highlight one company just to give listeners a real taste of what we're looking for down there. The company is called Global Scape. Its symbol is GSB on the New York Stock Exchange, and it trades around $3.45 U.S. Its market cap is in the $75 million range. Now, they are a pioneer in the secure, reliable exchange of business information. Their primary business is managed file transfer. So they help organizations securely transfer data, very sensitive data that you need transferred fast and securely. So for financial institutions, healthcare, a number of government institutions are their clients. Now, there's a good deal of companies that want to hold their data in the cloud, but many financial firms today, for example, see the data as too critical to be held in the cloud and need to securely transfer that data, and they use companies like GlobalScape software. It's really a sticky software business. Once you gain a contract in this business, 90% retention rate is what they're looking at. We like this company because there's a 5-year track record of above average revenue growth and a 4-year track record of strong earnings growth. The company had a bit of a hiccup in the first half of this year as they spent to achieve long-term growth and focus really on their core of their business. That is our opportunity, we believe, for the next 2 to 3 years. We think the second half of this year, the company will return to growth, and that's when investors will return to the stock. So we'd rather buy ahead of that. The company's looking. Yeah, sorry.
I'm sorry, I was just going to say it's a great example is when you've isolated a company like this, or and I know you look through hundreds of companies, but okay, so you've settled on this. You're looking for an opportunity to enter that market, as you say, so maybe the little blip that they've had is a good one. And then you have to look and say, okay, what's your potential for a continuation of the track record that saw their, margins grow and their profits grow and all of that kind of stuff?
Exactly. I mean, and that's what we saw here. I mean, we've been monitoring this company for about 2 years, and it's always been a company that we're interested in, but they've been executing so well that there was never a price that we thought it was reasonable at. But it came off for 15 to 20%, and suddenly it gets into a range where it's trading at $3.45 right now. We look at the balance sheet, which we like. There's no debt there. There's $1 per share in cash. So when we start to look at valuing just the business, we remove that cash, and it's $2.40 you're paying for the business. Well, we say, what will they earn this year? We think they'll earn 25 cents per share, so it's trading at about 10 times multiple of what they'll earn. Its peer group is trading at around 20 times, so it's a discount to what its peer group is trading at. So, if we look at a reasonable rate of return on this company, we think the fair value right now, if it starts to grow again in the second half of this year, is around $4.75, which is about 35% greater than where you're looking at today. It pays you a decent little dividend, about 1.75%, and right now it looks like it's growth at a reasonable price. Of course, the risk here is that management doesn't deliver on its growth objectives in the second half of this year. Some contracts slip into the next year, but at least you have that balance sheet backing it up, and you should see those gains next year. But there's always, the risk that the team doesn't deliver on this. But we think the upside is, 35 to 40%, just in terms of where the fair value is right now if the management team executes on the growth that it stated it believes it will in the second half of this year.
It's absolutely fascinating to see the challenge, when you look at that, because you're looking at growth companies, but are they growing too fast or whatever? We've only got about a minute and a half left here. Can you just give us another name that we can put on our radar? And then they can go to keystocks.com to find out more about it.
For sure. Sylogist is a company that we like. It's a cash risk software developer, SYZ. We recommended it at the Outlook. It was about $8 then. It's around $11.30 today. It's a software business that works for public and private sectors, collects data, analyzes that data, and makes sense of it for companies. But we love the organic growth rate, which is just growth from the business here. 45% overall growth in revenues in the last quarter, 42% organic growth rate. We just don't see that type of growth rate in today's market. Adjusted earnings were up 73%. No debt in this company, $1.43 in cash per share. This is a company that's upped its dividend 10 times in the last 5 years. It's that dividend growth stock potential that we're looking for in this company, and we think it's growth at a reasonable price, and if you're looking 1 to 5 years out, we'd buy Sylogist here today.
And that's SYZ. But the thing, I'll just finish with this, Ryan, that I love is if you'd bought it, and this, because it was part of the mainstays of the small cap portfolio of the World Outlook Conference, you made 10 times your money on the price of a ticket, and that's what I like to hear. Ryan, thanks for taking the time this weekend. It's always great to talk with you.
Excellent. It's great to talk with you. And you can call us locally or 1-800-27-STOCK. Thank you, Michael.